we go national, we go local, we go big, we go small. So our last session before lunch, and we're very cognizant between you and lunch, is going to just talk a little bit about some of the projects that are already happening in our community right now that are located in opportunity zones, to kind of give you a sense of the flavor for, and many of these are private entities, and the developers have not disclosed whether or not they will specifically use an opportunity zone play or not, but it'll give you a sense of the flavor to where some of the energy is at within the region. There's a real gap in terms of some of the smaller private neighborhood projects that are kind of simmering up, and that's one of the pieces that LISC would like to work on, kind of filling out in the discussion to kind of raise those profiles. You hear me? Okay, good. So you'll be, it was really interesting actually in talking and trying to assemble this panel. We tried really hard to get individual entities to talk about their opportunity zone project and around their willingness to kind of say, I'm doing this project and this is how the investment is likely going to take place with actually using this funding. And most people in the community were really reluctant to kind of jump on board and either disclose their deal or to have a lot of confidence speaking about it publicly. And that kind of talks a little bit about the newness of the tool within our community, the fact that we haven't, for the funds that have been created or for the deals that have been done, they're not being really outside of, I think, the work that Nick Sinatra is doing and maybe what we're going to see out of Blue Cardinal, who has, is talking a bit about their project work in Niagara Falls. People aren't really just claiming their stake into using this. And that's part has to do with development culture in generally. People are not always saying, I use this tax incentive and this tax incentive. But over time, as we try to understand the impact of this program, we're going to grow and do better about kind of really where the rubber is hitting the road. We're in an intersection where it's still new and people are still deciding how they're going to use it. So in talking with Bruce and the National LISC team, we looked at where the opportunity zones are located in our community and really what kinds of projects are potential candidates. So they fit in these broad categories: brownfields, the downtown mixed-use area, anchor and transit-oriented development, largely connected with our Main Street corridor, which gives you downtown medical campus, the university, and out into the Boulevard Mall area, workforce housing, rural and micropolitan plays, small business and venture capital. So these are kinds of the portfolio that we've at least been keeping our eyes out for. There are other dimensions. You can slice this on health or energy, and looking at some of those other pieces as well. And George can add, I'm sure he's seen almost everything coming up, through the process, looking nationally, because LISC is really getting into deals on some of these pieces. So just quickly, we have so many of our opportunity zones overlap with brownfield opportunity areas. I'm certain, if you're in Buffalo and you're doing development, you've got a fairly high level of familiarity, but the Lakeside Commerce Park is certainly included, Bethlehem Steel and Erie County and the ECIDA. They're going to be up to 250 acres of land there as a development opportunity, and certainly trying to make it shovel-ready and attractive for investors. The Tonawanda, another feature, getting into the Huntley plant and that area of our city and what happens next within that portion of the community. Niagara Falls and their brownfield opportunity area. So while we talked a lot about the Buffalo Billion, just the brownfield opportunity area process alone has really helped the communities that are facing these huge industrial sites think through what the next steps would be and what they would like to see in an ideal scenario for redevelopment. And they're huge properties, hundreds and hundreds of acres of land. And so they create all kinds of new opportunities for investment, no pun intended. Similarly, Batavia and the Brownfield Opportunity Area tool there dovetails completely with their opportunity zones, and then has been really part of that conversation as well. So it's not just something that's unique to the urban areas. 201 Ellicott, and this is another great example. The city of Buffalo went through its RFP process, has gone through community engagement around selecting sites and development opportunities, but it's mixed use, right on the edge of the downtown, with both affordable housing and retail. It's within the opportunity zone potential candidate for using the funds if the developer chooses to do so. This is Hotel Niagara. It's picked up by a Syracuse-based developer. And again, looking at this mixed-use development, this credit to the Buffalo News team for the photography here. And really looking at, ways that this helps to reinforce the downtown and that and their investment. Blue Cardinal Capital, which I think is 38 properties that they've closed on. I want to make sure I got the number correctly. And looking at, again, the opportunities for having, and they have said that they're using opportunity zone funding. And the idea that this is a slow process within that area. It's not going to be an instantaneous transformation, but they were talking about, renting up spaces, thinking through about how those transition and contribute to the downtown over a longer period of time. And then getting back into the city of Buffalo and the Buffalo Billy and commercial areas, we just took a couple of snapshots. So, Jefferson Avenue and these, key intersections. That's Utica, that's slicing through, and how do we actually then see this reinforce their small businesses? Particularly when, these are not necessarily experienced developers. They're busy operating their gas station or running the small shop. This one, we chose this particular site because if we are gonna, even within our neighborhoods, we have to navigate these brownfield opportunity area issues, underground storage tanks, dealing with, there are a couple of sites within those corridors where people get really intimidated when they understand that there's a former tank underneath the ground, and there's some of those smaller developments that can be really prohibitive for smaller developers. I know, I'm going to call her out, Barbara Rowe has got a property at the corner of Niagara and Jefferson, and just dealing with the brownfields issues there, when you're a small-scale, woman-owned developer, can really be intimidating. Niagara, what did I say? Oh, sorry. I know, I'm imagining the site. Sorry about that. Michigan Avenue and the African American Cultural Corridor. Again, the sign just went up yesterday. It's beautiful and so much attention there. Huge amounts of vacant land all along the city's the downtown eastern door, and what that looks like, how does it fit with the neighborhood as it comes to be redeveloped in Willard Park, so that it really feels authentic for the community to have that kind of revitalization. And how does it relate to Jefferson Avenue on the other side for the neighborhoods that are hugged on those two corridors? This is Mid-Main. This is a Sinatra-owned building, but just looking back towards the Utica station, the medical campus is in the distance, so these properties are still fairly underutilized, a lot of vacant and boarded up buildings. Again, how does this help what does the neighborhood want to see in these spaces? How do you pair that with investment to really achieve a vision that is authentic for the people who have stayed in these places, who've weathered significant amounts of disinvestment? How do they actually participate in the wealth building and the jobs and the investment here as part of this transition versus just our smaller traditional developers? This is a huge piece that's just on the other side of that slide. This is Cedarland's proposed development at the corner of Main and Best. For housing related to the medical campus, and again, huge potential transit-oriented development, dramatic change in property value, which makes it very competitive for somebody looking for this kind of investment. So we do have good candidate projects right now down Buffalo. But again, how do we also help those things land in a way that it's not causing displacement for the adjacent residents in the neighborhood there? This is housing just down the street from the Cedarland development. So how do we actually then work to take that development and have it influence the property values for the people who are here in the small house, as well as the properties that are boarded up there today? And with that, I'm going to turn it over to George because he's going to get into the numbers.
I'll get into the numbers a bit. To the point that you made about why it's hard to get real estate folks to talk about their projects. Having had some small background in commercial real estate finance, when you're a commercial real estate developer, your job is to keep your project out of the news. You kind of want to develop quietly, and then you can do promotion once you build it or once you pass all your permits, etc. So it's not too surprising that folks don't want to stand up here and talk about their theoretical projects quite yet. And some of that has to do with opportunity zones, but a lot has to do with just the way real estate development has happened traditionally. So I'm going to go over two projects. One's a housing project. The second is economic development, office space, mixed-use project. We'll dip into the numbers a bit just so you can understand how some of the capital stacks for these particular projects have filled in. I'll talk a little bit about other ways of inserting capital into the stack. The only, from an opportunity zone perspective, the only capital that's not allowed in the stack is soft equity or soft capital, because of course the equity for opportunity zone investors is sort of last in line to get paid out. Yeah, some interesting ways of doing projects, and this is just a few. So this is the project we are doing in Oregon. We're actually doing a single asset fund. We helped the developer, LISC, helped the developer acquire the site. It's a developer we've done a few light tech deals with historically. It's in Oregon, and it's a ground up. So they're building from ground up. So they don't have quite the same substantial improvement requirements because it's a new building. But here's some highlights of the capital stack. So it's new construction, 116 units. The rent's between 90 and 110% AMI. I will say, having capped the rents where we're capping them, it does affect the return, and so we're having to work with the investors, work through different conversations with investors about that trade-off. This is a proven project in the market, so there are other phases of the project. We expect it to be a single asset fund with high net worth individuals being the investors. Capital stack between 46% OZ equity. So one of the things that's interesting is there's also a trade-off in capital stacks between getting a lot of equity in the stack and the IRR. As you know, leveraged IRRs are higher than unleveraged IRRs. So when we're working with banks and CRA investors, or people who want to write larger checks, a lot of times they'll actually make a trade-off of taking a lower IRR in order to get more equity into the actual project. So just something to sort of play with as you think about your investments. And then investors get preferred annual cash payments and exit scenarios in 10 years. So this is not that deal. This is just another housing scenario, but because this one does require actually substantial improvement. But I want to walk through the numbers, and you'll see that there are numbers outside of each box. So I'll go in that order. Let's say you buy the project, total acquisition cost $7 million. $4 million of that is the land, $3 million of that is the actual building. Then you have to actually substantially improve the building with this new build. And this is actually where Buffalo may have an advantage. If the building's been vacant for 5 years, you don't have to actually spend all that money to improve it in order to make it an eligible investment. But in this scenario, because it wasn't a vacant building, you are buying it and you need to substantially improve it to make it an eligible investment. Now you have to spend $3,001,001, so more than what you actually bought the building for, the basis of the building. And so your overall CapEx, at the end of the day, with a rehab building, will be $10,001,001. I'm going to leave the $1 off because it's a lot to say, $10 million. Your initial financing. So you're making an acquisition loan and some developer equity that goes into paying the $7 million to initially acquire the building, some construction loan that could take out some portion of that initial equity, but let's just say it adds up to $10 million. And then let's talk about your permanent financing. So you may have $6 million in debt and $4 million in equity, and maybe you got a grant to cover some portion to be a part of the project as well, if it has some sort of community focus. I'm not sure why the formatting got off there. So, you have a developer fee of roughly $500,000 at the end of the day. So you're trying to get to the point where you can actually pay for the cost of building and rehab, and also create some benefit to the developer as well for doing the project. This is a simplified example, but let's just sort of work through it. On an annual pro forma basis, because now we have to produce a return for the investor that invested $4 million in red over there. So let's say your net income is $710,000, debt payments for $460,000, developer payments, we're paying the developer out over time, not up front. So then your annual equity payment is $200,000. And then if you look at this, you invested $4 million, $200,000 for 2 years, maybe you sell it for $11 million. And so your OZ post-tax return, depending on your own personal tax situation, between 7 and 11%. So I went through that probably, let's call that fast, medium fast. But that's sort of how it lays out in a very simplified version. As you see, the capital stack over here is pretty simple. It's equity and debt. I will say from what I've seen in the marketplace, for a lot of market rate buildings, this is not that unusual. For buildings that actually, like the prior, have some sort of rent control or some sort of community benefit, the stacks get more complicated. New market tax credits for office buildings, and we'll go with that in the next example. There's been some LIHTC twin OZ investments, but that's typically sort of an afterthought for what was already going to be a LIHTC investment. It's a very complicated structure. Lots of localized grants that developers can get to sort of keep the rents down so that the buildings are more accessible by the communities that are already in these opportunity zones. So it gets more complicated, but it's sort of like a base level pro forma for what you might see in a substantially improved asset investment.
I just wanted to flag a couple of issues that we've seen in working with smaller developers here, and particularly relative to, for example, the Buffalo Billion or some of the other deals here. So one, depending on what kinds of tax credits and other pieces, there's brownfield tax credits, there's historic tax credits, there's LIHTC. You're going to need access to, sorry, I don't have the mic. You're going to need access to a fair number of sophisticated experts to be able to help navigate those pieces. And not everyone has that expertise in-house. Fortunately, Western New York's got great technical people in that space, but it is an additional soft cost that we want people to be cognizant of. The other piece is that a lot of the grants that we're having locally are reimbursable. So they don't come, so if you're getting a Main Street grant, sometimes if you're getting some of the pieces from the state, it's very often a reimbursable scenario. So you have to upfront that money, and it's creating a structural barrier for a lot of our smaller developers and community members who don't have that cash lying around for either the grant covered costs or any of the early work with architects, engineers. So that's the timing issue on that is something that doesn't show up, but it's something that we are definitely talking to a lot of our partners about to see if there's an opportunity for us to overcome that locally.
To be a gap lender, or
Well, to see if there are,
yes, cash flow lender. Yeah, bridge cash flow. Yes.
yes.
Commercial for LISC. We want to be a bridge lender to help. No, we actually do. I mean, it's important that not only is there equity in the actual building itself and the rents and folks who can sort of rent in those buildings, but there's also an equity perspective on who is building the real estate, right? And allowing for different parts of the community to come into that part of the value stream as well. So it's really important to create diversity there also. Okay, so that was the housing example. This is now a mixed-use economic development example. So it's a really exciting location in Washington, D.C. This is actually the anchor project for our OZ Mid-Atlantic Fund. We are partnering with a minority developer that is doing this work and some work in Boston as well, Worcester, outside of Boston, and some work in Philadelphia, all around this concept of public-private partnerships. So this developer has done a really good job of following and working with municipal stakeholders to go into new areas that are in OZs and to win the rights to develop land and sites that were formerly municipally owned, and then utilizing that as an anchor to then invest in other buildings around it as well, so creating this sort of new Main Street concept. So this particular building is called MLK1, and you can see the capital stack here is a combination of bank debt, so now we get a little more complicated, subordinated debt, new market tax credit equity, opportunity zone equity, and then sponsor equity, which is the equity from the developer itself. And so all that adds to $22 million. It's actually even more interesting than that. So we did listed the pre-development loan with the lender to help them acquire the site. LISC is also contributing a fair portion of the new market tax credits that go into the deal. There is something to be careful about if you're the new market tax credit allocatee and you want to be the equity investor. So we're also going to help out with the Opportunity Zone Fund Equity as well. So pretty involved in this project, but I think it sort of spells out a few themes that I like. One is, of course, that we're, again, having diversity in who the developer is, but that we're also integrating with the local government. We also heard from the community that they didn't want more housing in this area. They actually wanted office space, and so we're bringing in a large tenant to sort of be the core tenant for the office space. It's a tech-based company. And then at the ground level, we're actually working with Streetlight Ventures and one other entity to help do tenant improvements to bring local minority women-owned businesses at the ground level as well. So it's thinking about sort of multifaceted approaches to how you benefit the community, but also do well by the investors that I think is really powerful about this program. And this is a building in Milwaukee that was municipally owned that they're turning into Opportunity Zone investments as well. Actually reminds me of some of the infrastructure I see here. And then blended capital approaches. So I've talked about a few of these things already, but as you think about capital stacks, again, pulling in everything you can to sort of increase the impact for your investment is how we sort of think about things. So new market tax credits, grant funding, tenant improvements, talked about that, pre-development lending, technical assistance, impact preferred equity tranche. So this is something that we've been talking with a few impact-focused funds about. Is there a way to insert sort of a mezz equity tranche ahead of the common equity holders that's sort of capped at 5%? That gives the sort of it's preferred in the waterfall, so they get paid out first. It acts as sort of leverage in the overall transaction, but it allows impact-focused opportunity zone investors to be a part of the fund. And it increases the IRR for the common equity shareholders as well. So we're working on this with one or two banks to see if this makes sense in impact funds. Yeah, and we'll talk, actually later we'll talk about transfer of equity home ownership models with Ted, who's your things to think about. To the question about the inverted yield curves, I think that was your question, right? So in thinking about different asset classes, one of the ways we thought about affordable or mixed income housing is actually as an asset class, because historically Goldman Sachs did a study on this, it actually performs way more resiliently in a down economy than luxury houses and luxury apartments, etc. And so on a risk-adjusted basis, if you think about your returns, especially in the environment of an inverted yield curve, global macroeconomic recessionary pressures, front page of the Wall Street Journal a couple days ago, it's actually thinking about protecting your principal as an investor, protecting the gain that you already have. It's actually really good to think about maybe integrating to your portfolio not just luxury or market rate stuff, but also some sort of affordable or mixed income housing to sort of that will act more stably in poor economic times, which hopefully don't come but could. So thinking about that as ways of positioning impact investments, so that it's not just about lower returns, but it's also about thinking about the risk of those investments. And then there's a few other suggestions here about thinking about favorable permitting, CRA eligibility, avoiding bad press. Under Armour in Baltimore, you probably all saw that story about their not so good press and their investments. So lots of reasons why impactful OZ investments make a lot of sense from an investment perspective. I could sort of compare it to the whole climate change, which at first was all about hugging trees, but eventually actually became about dollars and cents, right? Eventually over time we realized that you need to consider the trajectory of the climate and climate change in your investments to make good, sound fiduciary investments.